Welcome to our investing FAQs. This is a safe space where I'm going to be asking Fede questions around investing and personal finances. These are the type of questions that come to me every single day. And I usually just send Fede a really long 10-minute voice note asking them. But we want to bring them to you because we think you may have the same questions.
Awesome. What's on your mind, Mire?
Okay, question of the day. I've noticed that the market keeps going up and down. I think this week it just hit all-time high. Last week it was low. Honestly, I know you're taking a shot of whiskey every time it hits all-time high. So that means today you're going to take a shot of whiskey. But the question is, how do I know when is the best time to invest? The market just hit all-time high. What does that mean? Does that mean I should wait to invest until the market is back to low?
That's a great question, Mire. And the truth is that news outlets and headlines are usually fixated on this concept of all-time highs to catch your attention. When the market falls, they usually sensationalize it a bit more to get you a little bit more concerned and in turn more engaged with the news. When the market is on an all-time high, does not necessarily reflect whether the market is expensive or cheap, because you can still hit an all-time high and people can still expect the market to trend higher if they think that the valuations or future growth expectations may justify it.
You're getting a little confusing here. What can you rephrase that?
Let me rephrase that. Oftentimes, people assign market valuations based on what it's called a multiple on earnings. What that means is usually the market has paid, think about market cap, what the equity is worth, the price of that stock, times what its earnings are. So when sometimes people will say, oh, the market is cheap, it's because the S&P 500, for example, its current price is, call it 13 times earning. That hasn't happened in a long time, but that could be an example. There were
And
times.
is it based on the earning of the S&P, so of the equity itself?
Correct. So it's based on the earnings of the combination of all the stocks within the S&P 500. You can do price to earnings multiples of individual stocks, but usually it's referred to price to earning multiple of the entire S&P 500, which is the combination of these 500 stocks.
Right.
When people say that the market is expensive, it's the opposite. So if it has a multiple, which it has had in the past of say over 20 times price to earnings, then it might be considered expensive, right? Now, you might reach an all-time high, but still the multiple is within a historic range or is considered to be cheap. Now, whether it's considered to be cheap, expensive, or fairly priced really depends on so many factors, and each analyst or each investor will have a different opinion upon it. So that's number one on what it means that the market is expensive or cheap. That's usually what's referred to.
I guess the follow-up question is, okay, you're saying that the all-time high doesn't necessarily equate to the multiples of the S&P 500. So what exactly does all-time high mean then?
It just means that the index is trading at its highest point in history.
Gotcha. Okay, that makes sense.
Okay, so, but that doesn't mean that it's expensive or that it's cheap. It just means that it reached an all-time high. But it's often used to sensationalize the fact that it just reached a new level never before seen, and it catches your attention and it makes cool headlines. But it really doesn't mean anything.
But then,
outside of me taking a shot of whiskey.
Okay, so what does the all-time high mean in the context of waiting or not waiting to invest?
So it really doesn't mean anything, because the fact the market reaches an all-time high does not indicate whether the market is expensive or whether it's cheap. What will impact that is how much earnings grow, what is the multiple currently assigned to the market, which can vary based on earnings expectations. Now, what you can know, and this is, I think, the most important takeaway and what you should probably focus on, is don't give too much weight to when the market is cheap or when the market is expensive, because again, it's very subjective. And oftentimes we are swayed by headlines that really are not indicative of future performance. And what do I mean by that? There have been a lot of analysis done of what happens when you miss out on certain days in the market and its impact on your performance. What do I mean by that? I think one of the common, let's say, detractors or reasons to not to invest is because somebody might say, oh, the market's going to go into recession, it's going to go lower. Have you ever asked that? Have you ever asked that said that to yourself?
Honestly, no, but sure. Let's see. So maybe someone that's listening has.
Indulge me for a second. When you're in a recession, oftentimes people are afraid to invest because they think it's going to get worse. But a lot of the best days in the market are often during a recession. So for example, in 2008, what comes to mind in 2008?
The recession?
Yes. October of 2008, there was a day when the market, October 13th, 2008, the market was up 12%. Now, let's go back to March 2020 during COVID. What comes to mind for you when COVID hit in March of 2020?
Pandemic.
And in terms of the stock
Obviously,
market?
COVID.
End of the world. Yeah. Well,
Yes.
On March 24th of 2020, the stock market was up 9%.
Yeah.
April 6th, 2020, the market was up 7%. So what I'm trying to get to is that even...
Yeah, that's crazy. Why the stock market went high.
Exactly.
It was an all-time high.
So even when you think it can't get worse and it's going to get worse, usually it's never the case, because markets also are what's considered forward-looking. So oftentimes you won't know, like whenever the worst happens in the economy, the market already anticipated that fact and has already kind of moved on and improved. And the overall impact on total performance is staggering. I'm going to give you one last data point just to bring this point home.
Not another data point.
Just one more. Bear with me.
Okay.
If you invested $10,000 in January 1st of 2003 in the S&P 500, by the end of 2022, those $10,000 would be worth almost $65,000. That equates to an annual return of almost 10%. That's 6.5 times your money. Okay?
Yeah.
Now, if you missed out on the 10 best days of the market, let's say you thought the world was going to end, like everybody thought in March of 2020, and you sold, and you missed out on that March 24th date of 9% rally, and you missed out on 10 of those, call it.
Yeah.
Your money would have been worth less than half of that. You only missed 10 days. You're talking almost 20 years. That is more than 4,000 trading days. You only missed 10, and your money's already worth half as much as if you stayed invested. So the lesson is, don't worry about the headlines, because the opportunity cost of disengaging and selling and just getting out of the market is extremely high.
Yeah.
And
I've never seen you this passionate about something.
And you will always find a data point that makes you think that the world is going to end or that the market is expensive. And the truth is, nobody knows. So don't try to solve it. I don't know. Nobody knows.
Nobody knows.
Nobody knows.
I have a follow-up that's like going to ground us down again, but I think this is interesting. Let's talk about one stock, right?
Okay.
Let's say the Spotify stock.
Okay. I love Spotify.
It was worth $200. Then there's signs where it's worth $300. Then there's signs where it's down to $150. I don't know what it is right now. Honestly, I probably should since I work there, but I don't.
Okay.
How do I know? Maybe you can check for me. How do I know if it's, like, let's say you, right? Like, would you buy Spotify stock now? Or should you wait until the price is lower, let's say, knowing that it fluctuates so much?
So Spotify stock is worth around $265 right now. And you asked me if I should buy more stock. And the truth is that it requires a level of analysis that I'm not prepared to give you an answer that will make any sense. Because again, the price, it's kind of the all-time high analogy. Yeah. The actual price is worthless. in the end, a stock may be worth 1,000. It doesn't mean anything, right? Because then they do something called a stock split, which then from one day to another, it's worth 10% of that, but the market cap doesn't really change. Its equity value doesn't change. It's just the stock price. So to your original question of whether I should buy more Spotify or not, it depends on your view of future earnings of the company and the multiple you're going to assign to it based on its expected growth. And getting to that answer is extremely, extremely difficult. That for 99% of the people, it's not worth doing.
Okay.
We good?
We're good, I guess.
Awesome.
Yeah. Thank you.
We'll see what other questions we have in the future and we'll look to address them.
Sounds good. Cheers.
Saúde.